From New York City for our viewers worldwide, I'm Matt Miller. Futures hovering around zero after disappointing retail data. The countdown to the open starts right now. Coming up, yields falling, futures muted after the latest retail sales print undershot estimates. Goldman Sachs sticks to its call for 2 rate cuts this year, saying the U.S. labor market stands at an inflection point, and Citi places its services business front and center as part of its company-wide revamp. We begin, though, with the big issue, the S&P 500 notching yet another record high.
I think the bull trend continues. It may feel choppy. We may get a pause here in these early summer months. And what we've been saying to clients is this bull may turn into a buffalo and start to roam a little more, but I think the uptrend is intact.
Joining us now, Ann Sonders, Charles Schwab Chief Investment Strategist. And Ann, amid a flurry of economic data, we still hit another record high. How much momentum are we seeing in this market?
There is, but it's obviously very narrow. So we're in a very rare situation where at the index level, the market's incredibly overbought, yet at the average member level, the market is incredibly oversold. So take your pick as to whether you're only focused on the index level. We continue to rip higher, but we have fewer and fewer stocks participating. And that's a risk. But, knowing the point at which you start to see convergence, that's unknowable, but it is a very concentrated market.
Yeah, you put a really interesting point in your notes, and I wanted to show the graphic to viewers as well, just to get a sense of how many stocks in the S&P 500 are actually outperforming the index. It's a very small percentage if you look at the last month or 3 months, but if you bring it out to 1 year, only 6% of S&P 500 members are outperforming the index. What does this mean to you?
Well, so having a market that is concentrated and having cap-weighted indexes be driven by a small handful of names in and of itself is not necessarily a problem. That can last for an extended period of time. The problem arises when the rest of the index, the rest of the market is significantly underperforming, when you have that significant bifurcation. And that kicked in earnest in last year and then started to ease a little bit and really started to ease when we hit the peak in yields at the end of October. The move down then became a huge tailwind for the equal weighted index relative to cap weighted for small caps, but that was somewhat short-lived, particularly as yields started to move back up again. So it's that spread. And what I would like to see is a little bit of a pullback up the cap spectrum in some of those high flyers, but at the same time, some sort of under the surface subtle improvement in breadth that may not be picked up by index-oriented investors, but that would be a positive divergence. We're just not seeing that at this point.
What's your view on the economy right now, Ann? Because Jan Hatzius over at Goldman Sachs says GDP growth has slowed meaningfully, and they're sticking with their call of 2 cuts this year, but they point out that the labor market is showing us mixed signals. We got non-farm payrolls adding jobs. I think 273,000 jobs. At the same time, the household survey lost 400,000 jobs. How does the economy look to you?
So I think the economy is slowing. Retail sales certainly supports the consumption side of the economy being weaker than what we've seen in recent months. And, to your point, Matt, about the payroll data versus the household survey, for what it's worth, at inflection points in the economy, when you're in a slowdown, the message from the household survey tends to be the more accurate one. Not to mention the fact that there is so much buzz and chatter about the QCEW survey that suggests that payrolls on a monthly basis are probably overstated to the tune of 60 to 70,000, in part because of the BLS's birth death assumptions that they make. That's the birth of death of businesses, obviously, not of people. And so I think when we get the annual benchmark revisions, which is not until it's February or March of next year, I think you're going to see the payroll data catch down to the household data. So I think we are seeing a material softening, nothing nothing disastrous, but it witnessed in the labor market. And that goes back to why the Fed might be able to start easing policy absent a move down in their core PCE favored inflation metric to their target. It is the labor market may give them the green light to start easing in advance of that inflation target being hit.
So, I mean, we can see this slowdown, right, if you just look at the GDP prints. At the same time, Liz Ann, corporate profits are picking up, right? We've had this expansion over the last 3 quarters. In a note from ISI, Julian Emanuel said he expects corporate profit to grow 8% this year, 5% next year. He raised his target on the S&P to 6,000. How do you square that circle with the economy slowing down and corporate profits really doing well?
Well, it shows that companies have done a very good job in the aggregate of maintaining profit margins, because where we have seen much more weakness is in top line growth. So for all the justifiable cheering of bottom line growth, earnings growth, near record high in terms of the beat rate, percent by which companies are beating, you have nowhere near that same strength on top line growth. You see a below average revenue beat rate. The level of top line growth is much lower. And for what it's worth, it's revenue growth that tends to be a driver of what happens in the labor market, what companies opt to do in terms of cutting costs on the labor front. A lot of the cost cutting has been outside of the labor market. I think this next reporting season will be interesting in the sense that from a forward-looking basis, we will see in a more constrained top-line growth environment how companies are going to be able to continue to maintain those profit margins. Does it start to eat into labor costs?
How do you talk to clients about portfolio construction right now? I guess, rebalancing is a term I've heard a lot over the past couple of days, and yet, as long as you left all your eggs in one S&P 500 basket over the past 15 years, you're outperforming pretty much anything else that there is. How do you deliver clients the message that they need to stay safe and diversify?
Well, on the rebalancing front, first of all, it's always a great discipline. It's one of those beautiful disciplines that forces us to do what we know we're supposed to, which is a version of buy low, sell high. It's add low, trim high. When left to our own devices, we tend to do the opposite, or at least let the winners run. But one maybe subtle shift we've made in terms of recommendations around rebalancing is a lot of investors, certainly on the institutional side of things, do their rebalancing based on the calendar. Mutual funds tend to rebalance the final week of every quarter. A lot of individual investors do it on an annual basis at the end of the year, maybe something tied to tax liabilities. But we're suggesting that if the maybe additional turnover doesn't impact, consider portfolio-based rebalancing, actually letting shifts in asset classes or individual stocks dictate when it's time to maybe pare back and take some profits and add to areas that have underperformed. And I think particularly now that's an important discipline, because a lot of the research shows that particularly down the age spectrum, there just has not been a lot of rebalancing. And it's great when the S&P is outperforming everything else and that cap-weighted index doing well because of the high flyers. That doesn't last forever. And the downside, of course, is the downside of these cap-weighted indexes. You have a concentrated weight in names at a point of convergence can cause more angst.
So does that mean, take profits from the Magnificent Seven? Does that mean, sell off some NVIDIA and buy some REITs?
Well, I'm not going to make recommendations specific to any individual names. That's not what I do. I fly around at the 30,000 foot level. But I think, paring back along the way without honing in on any particular security. What's your ultimate goal? What is your overall asset allocation? What's your exposure to equities that make sense? Understanding the concentration risk and the potential peril of that, and whether you can handle the pain, inevitable pain on the downside when you get some reversion to the mean. Right now, you mentioned specifically enroll into REITs. We happen to have an underperformed rating on REITs, so that wouldn't be our specific recommendation. But I think there are still opportunities to stay up in quality, but move away from some of those high flyers, certainly as it relates to new money being put to work within portfolios.
Liz Ann, great to catch up with you. Thanks so much for joining us on the program. Liz Ann Sonders there of Charles Schwab. Joining us now with a look at some of the individual names moving ahead of the opening bell is Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, it's interesting, Matt, because beneath the relatively benign surface, we have lots of big movers. Let's, of course, start off with the AI-related names, because Broadcom right now is heading to an 8th straight up day in a row. That would match the longest winning streak going back to 2023. So after that big quarter and, again, the AI strength, investors flocking to the shares of Broadcom, although a little bit off the highs after that retail sales report. And same deal with NVIDIA. This stock had been higher. Rosenblatt did raise its price target to a street high of 200 on the software aspect, those shares up ever so slightly. Let's keep it going, though, with the chips, because we do have Micron trading higher, too. And this after Bank of America saying that the AI play, it's not directly related to Micron, but that memory and storage could do well on AI. And that's one reason to like Micron and ARM, for that matter. Lazy Boy really surging, up 9.3%. They put up a good quarter, and their outlook was also positive. Not even a huge short interest there, so that's genuine buying. And then finally, to the downside, we do have Philip Morris trading lower, and this after they stopped their online sales of their popular nicotine pouch brand Zyn in the U.S. after receiving a subpoena in D.C. related to flavored products.
Interesting. I know it's been all the rage among the kids, the Zyn packs. We used to call those bandits, but it's a little different. Abigail, thanks very much. Abigail Doolittle talking to us about some of the stocks on the move. Lazy Boy, a big gainer, up by a 1/10 today. Coming up, it's a busy week for housing data. Those two maybe go hand in hand. We'll discuss value opportunities in real estate with David Auerbach of Hoya Capital next. This is Bloomberg. We are watching homebuilder Lennar this morning. Shares falling after it delivered a weaker than expected outlook for the third quarter. After the bell, we're going to get more results from the real estate space, KB Home to be specific. Drew Redding, Bloomberg Intelligence U.S. home building analyst, joins us now to give us the lay of the land. Drew, I saw, mortgage applications absolutely soared last week. What's it telling us about the rest of the industry?
Well, you have to remember they're soaring off a very low base. If you look at sales of existing homes, we're still down about 35% from early 2021. We've been describing the housing market as a tale of two markets. You've got weakness in the existing home market with relative strength in the new home market as builders have had the supply and they're able to make the math work for their buyers by buying down mortgage rates.
How much do rate cuts from the Fed matter? I mean, as we all know, they've only penciled in one in the most recent dot plot, down from 3 in the previous print. Is that a bummer for the housing industry?
Well, I think it's certainly something investors are latching on to. We came into the year looking for 5 or 6 rate cuts. We pared that down to 1, and you've seen the stocks kind of ebb and flow with those expectations. In terms of demand in the market, what we've heard from the builders is that 5.5% mortgage rate is kind of that sweet spot that really gets buyers into the door. So if you're looking at a headline rate that we are right now of about 7%, builders are able to buy that rate down to about 6%, and in some cases 5.5%. So, if rates stabilize or pull back a little bit into the mid to high 6s through the end of the year, we think that from a rate perspective, the builders should be okay.
Is family formation a problem right now, Drew? I mean, are people having enough babies and going out with housing demand?
I think in the near term, household formation is still very strong and supportive of the housing market. You mentioned birth rates. I think that's something that could impact the market, but that's something that we're looking at way down the line. In the near term, the demand's there. It's just how much are buyers willing to pay. And I think that the fact that in the new home market, monthly payments are almost at parity with resale. So I think that's one thing that's helping the builders out here.
All right, Drew, thanks very much. Drew Redding there of Bloomberg Intelligence covers the housing market for us. For more on real estate, David Auerbach joins us. He is the CIO at Hoya Capital. Hoya specializes in managing portfolios of publicly traded real estate securities. You have your own ETF, REIT, right? R-I-E-T rather than R-E-I-T. Talk to us about the if we're at a low, if we're maybe at an inflection point here for real estate investing?
Well, if you talk to the publicly traded REIT guys, they would say that we've, on the way to turning the corner. Looking at previous cycles, a lot of these REITs have been able to hunker down, improve their balance sheet, lower their leverage, dividends are increasing, earnings are increasing. And so by and large, even though we hear these headlines of doom and gloom, commercial real estate, wall of debt, all of these negative headlines, talk to the individual REITs themselves and they're like, no, fundamentals are strong. We're able to properly manage our debt stack over the next few years, focus on the operations and look at the bigger picture.
Right, and this is kind of what we heard from Bill Gross on the close last week. He was talking about, regional banks that he thinks already have put enough aside to deal with any fallout. But in terms of the price action, I mean, it can be doom and gloom. If the price is down far enough, it's a good entry point, right? Do you see that across the space?
Absolutely, especially in some of the small and mid-cap REITs. We think some of these guys are extremely, frankly, deep value plays. If you look at across the 11 GIC sectors, real estate, the bottom performing sector. Look at year-to-date performance, real estate, one of the worst sectors. But yet, again, FFO, the REIT earnings number, continues to go up. Dividends continue to go up. Over 50 REITs have raised their dividends so far this year. We focus on the REITs that pay the highest dividends with the lowest leverage ratios. And so we kind of ignore this wall of debt looking at the individual constituent level.
The GICS sector, jargon alert is what Tom Keene would have said back in the day. You're talking about the
S&P
industrial breakdown on the S&P.
Yes.
We can pull that up on the Bloomberg terminal with the GRR, the group rank returns. If you look at it year to date, you're right. It's the biggest underperformer. It's the only one in the red here. You can see real estate at the bottom. Obviously, IT and communication services are there at the top. REITs are not a monolith, right? This country is broken down into many different regions that are all performing at different levels. Where do you see the winners and the losers in those terms?
Sure. So if you look at on a sector by sector basis, obviously some of the sectors like industrial, single family rentals, data centers, those sectors have been on fire. If you look at regions, Sunbelt apartments obviously been in focus, Sunbelt industrial, where Amazon goes, that's kind of dictates where things are heading. And so in certain cities as well, like New York, there's pockets of strength, there's pockets of weakness. I mean, it's almost on a sector by sector or a street by street basis. Perfect example is Blackstone. Blackstone, in one hand, is buying in certain markets, and in the same markets, they're selling assets. Right. Look at what's happening with their private REIT vehicles, both with Blackstone and Starwood. And because of what's happening in some of these vehicles, this provides that opportunity for some of the publicly traded REITs to potentially acquire some great assets at great prices because of the strength of their balance sheets.
Right. I see it. I'm from Granville, Ohio, and Intel is building a huge plant right down the road from us. And as a result, home prices in some places have just, doubled.
But it's also going to lead to more apartments, more single-family rentals. I was in West Village yesterday looking at Google, Apple, Samsung, all of these new companies that are moving into the area. But there hasn't been a big residential component that's followed along with all these companies going. And so when you kind of look in the microscope or the crystal ball of 5 years down the road, West Village, as an example, is going to look completely different on the resi side than it does today. And again, it's going to be some of the publicly traded REIT guys that are the driver towards that.
In terms of commercial real estate, I mean, people describe it as a slow motion train wreck, right? I think Bruce Richards from Marathon was on the close yesterday saying it's the story of a python swallowing a pig. How far along is that pig?
I would think, especially since the REITs have been in this higher for longer, or now just high for long environment for a couple of years, we're operating in an environment where we know there's only going to be maybe one rate cut this year, maybe. And so as a result, I'd like to think that we're pretty far along in this beat up situation, especially for those companies that are exposed to variable rate debt. Since so many REITs have a huge component of fixed rate debt, they're able to navigate these waters pretty easily right now. Obviously, should we see an uptick in rates or things turn, then obviously, again, the variable rate situation changes. But from where I sit, the 10-year Treasury is trading around, I believe, 4.25 right now. The average REIT dividend yield, when you include mortgage REITs, is around 6.9%. So that gap is widening between REITs and fixed income. For us, running the high dividend yield REIT ETF, when you also include the layer of preferreds, we're paying an index dividend on a monthly basis that's annualized over 10%. Because we're seeing opportunities in small and mid-cap REITs, in mortgage REITs, in preferreds, we just take a completely kind of contra approach that some of the large cap, equal market cap weighted players do.
How much do rate cuts matter, and what do you expect?
I mean, dramatic. I think, as I like to say to folks, when the Fed announces the rate cut, hopefully whenever, September, December, when they make that announcement at 2 o'clock, at 2 o'clock in 1 second, the REIT sector immediately responds. At 2 o'clock in 2 seconds, when the advisor calls their client to be like, hey, the Fed cut interest rates, it's time to buy REITs, that ship has already sailed. So it's our job to try to educate investors and advisors why it's important to start increasing or positioning towards REITs today for what's inevitably coming down the road tomorrow.
All right, David, great to get some time with you. Thanks so much for coming into the studio here. David Auerbach there of Hoya Capital. His ETF is REIT. RIET, sorry. RIET, so the opposite of REIT.
Because income comes first.
Income comes first. All right, a great pitch there. Coming up, the morning calls, and then later, Invesco's Ben Gutteridge joins us, and we'll discuss why he finds European equities appealing, even post-snap election call. This is Bloomberg. All right, taking a look at this market, we're climbing a little bit in terms of futures, not much, but at least the arrow is up and the color is green. It's so important to watch the economic data. So if you have a Bloomberg terminal, EcoGo is your friend right now. Maybe more important than the Fed speak that you hear. This morning we had retail sales that were disappointing. This number turned red. Then we had industrial production figures that were a little bit better than anticipated, and now we see a little bit of green here. So keep your eye on this space, still at a record high on the S&P 500. We hit 54.73 in the cash trade yesterday. Time now for our morning calls. Take a look at some of the analyst recommendations on Wall Street this morning. First up, Rosenblatt Securities raised its price target for NVIDIA to a street high of $200 from $140. The analyst emphasized the strength of the chipmaker's software alongside its hardware. Next up, BMO raising Kroger to outperform with a price target of $60 apiece. The analyst says the supermarket chain is well positioned whether its deal with Albertsons happens or not. And then finally, Apple downgraded to a neutral at Phillips Securities while increasing the firm's price target to $220. So they still have moved their price target up. Obviously, the price is almost there right now. The analyst says the newly announced AI features will trigger a replacement cycle. You're going to want to go out and buy new iPhones if the one that you have doesn't enable you to work with the AI that they're bringing out. Coming up, Ben Gutteridge of Invesco joins us on the Goldilocks, what he calls the Goldilocks environment for stocks. Is it still there? This is Bloomberg. This is the countdown to the open. I'm Matt Miller. We're just moments away from the start of trading, and we're seeing futures, at least on the S&P contract, fluctuate between gains and losses. We were down this morning after retail data disappointed, then industrial production data impressed, and we're up again, but still basically hovering around zero. And why not? We hit a 30th record high on the S&P yesterday at 54.73, so investors remain bullish. There you heard the opening bell on the New York Stock Exchange and down at the NASDAQ site. And you can see in terms of futures, not a lot of change. Let's take a look at some of the other instruments that we watch. The euro has been interesting to watch lately as it's fallen back down below 108 to 107.33. We're going to talk to an investor in Europe to see his take on what's going on with these assets. The 10-year yield in the U.S. at 424, 425, and NYMEX crude right now up over $80 a barrel. In terms of stocks to watch at the open, Chegg is one of those stocks. It's jumping after the online education platform announced a plan to cut 23% of its global workforce. That plan also includes a push into AI. So it's happening. The robots are replacing us. Here with more is human Abigail Doolittle. Abby?
Very human, thankfully, Matt. And there's a lot of things to point out about this. First of all, a lot of people into today probably had never heard about Chegg. Second of all, yesterday, Chegg was at an all-time record low, having been down 7 days in a row. Third, this is a penny stock. In 2021, it was a greater than $100 stock. So the fortunes for Chegg into this big surge have not been so great, in part because profitability was much more significant in 2021 when they put up 57 cents per share. This year, they're modeled for a loss of 4 cents. So investors are very excited about the possibility that they are going to drive costs and they are going to drive growth and cut costs. The plan, the workforce plan, is to cut 441 employees from their company. Relative to the stock today on this, we do have a pop of about 12% right now, the best day going back to November of 2023. I would note there's not surprisingly a big short interest on this, nearly 20%. So today is a bit of a squeeze. Let's see how this one goes as more time moves on and to see whether or not they accomplish their new goals.
All right, Abigail, thanks very much. Abby will be back later on in the program. Right now, another company riding high on AI is Broadcom. It's set for its longest winning streak of the year. It had an awesome week last week and continues in this week's trade. For more, we're joined by Bloomberg's Emily Grafeo. Emily?
Yeah, Matt, we'll see if those gains hold into the end of the day, because that will make it the longest winning streak of the year. But now it's only up about 0.2%, oscillating between gains and losses after the opening bell. But nevertheless, that stock has been on fire, adding $200 billion in market cap just over the last week or so. And the moves today follow blowout earnings last week, which showed that strong demand for nothing other than AI, Matt, has really been driving Broadcom's growth here. The chip supplier supplies products for big tech companies like Apple, and it offers a range of components that are used in computing and networking. So the AI frenzy in the market has really been a big boost for Broadcom. You look at what Barclays has to say, Broadcom remains one of the best ways to play AI, and the rest of the street feels the same way. 36 buys, 7 holds, and 0 sells for Broadcom, Matt.
All right, Emily, thanks very much for that. Now turning to the sky, Rocket Lab shares are lifting higher after announcing the largest launch agreement in the company's history. Joining us now is Natalia Knijevic on Rocket Labs.
So the stock is up by 8%, Matt, today. That is the biggest, as you said, agreement for the company. The customer is a Japanese space company, and it's been a long-standing customer for Rocket Lab. So now, basically, this is a commitment for 10 launches until 2027. The terms of this agreement were not disclosed, but investors really liked this because, basically, this shows visibility for a long-term pipeline. And some analysts are saying this could probably be an example for other customers to make similar commitments. But we do have this excitement today in terms of the stock price. But overall, year to date, the stock is down 22%. A few reasons behind that. So the last quarterly report showed that revenue was lower than analysts expected. They also had an unsuccessful launch last fall, and the company is working on a very big project. It's a big rocket called Neutron, and as of now, the company produces small to mid-sized rockets, but this project could allow Rocket Lab to be a direct competitor to SpaceX Falcon 9. But again, this project requires lots of investments.
All right, Natalia, thanks very much. Natalia Knijevic there on Rocket Labs. By the way, in the next hour, we're going to speak with the CEO of Rocket Lab, Peter Beck. Sir Peter, to be exact. He's gotten the Lord title since, is a Lord? I don't know. He's a sir, in any case, is what we say. Joining us now is Ben Gutteridge. He probably knows better than I do about these titles because he's the investment director of investment solutions at Invesco and is over there in the land of lords. Ben, first of all, let me get your take on French stocks and the effect of the snap election that's coming up. It seemed like investors were all going to pile back into Europe. You saw the stock 600 really start to pick back up, and then this kind of freaked people out, Macron's call after the win for the far right there. is everybody going to now abandon the continent?
Well, in answer to your original question, it's actually a knighthood.
Sorry, he's a knight. Yes.
In relation to French stocks, I think we've sort of seen this type of movie before. It's sort of a classic reaction from markets. Hedge funds get their new toy, and they sort of respond, sell down on sort of negative political developments. I mean, the concern is that a populist, sort of quite far right party take over the French Assembly, the French Parliament, but doesn't take much digging to appreciate that the probability of that is very low. So we don't expect any type of French exit from the EU. Far from it in terms of policy agenda. Any abandonment of the euro. There's a bit of a roadmap with what we saw in Italy, as some might consider more of an extreme sort of party securing power and adopting more moderate policies when they reach the pearly gates. When they reach that position of authority, anyway. So I think the markets have overreacted here, and therefore suggests a bit of an opportunity.
An opportunity because people do tend to freak out at these things. Where do you see the biggest drops, the biggest losses, the biggest entry points in terms of European stocks and bonds?
Well, I think it would have been sort of the utilities that have seen the biggest drop. They had the closest relationship with sort of government bond performance, and French bonds really taking a bit of a hiding, certainly relative to other European bond markets. But that's also sort of bringing to markets' attention that the public finances in France aren't quite as neat and tidy as in other nations, certainly relative to Germany. So it could be a little while before French bonds recover, and therefore that discount in utilities might narrow. And therefore you think on a sort of a risk-adjusted basis, that it's probably French financials, the banks, that look like the most interesting opportunity. Yes, some linkage to bond markets, but not as keenly correlated as utilities. And we think the growth outlook is pretty reasonable in Europe at this moment. The ECB cutting interest rates, real incomes looking reasonable. So wage inflation okay relative to fading inflation. So on that basis, the banks look like a better trade in amongst the opportunities that are presented.
Does all that, though, Ben, look better to you than, the AI boom that's going on over here? Do you feel like it's run its race already, that there's no more room for higher highs?
Well, I don't trade particularly short term. In the very short term, one might suspect that these sort of European discount opportunities do look more appealing given the relative performance of late. But over the medium term, I wouldn't say so. No, I think we'll be continuing to leaning into US equities, particularly those of sort of loosely defined sort of technology theme, the home of innovation, and this tremendous AI earnings momentum that we're seeing. Recognise it could be a bumpy ride, but would not want to take that exposure away from portfolios at the moment, given the tremendous earnings performance we're seeing and the seeming inability for investors to be able to value these companies appropriately.
I wonder, when you look at what's happening in Europe, it's already kind of happened in Britain, is that the status quo is essentially thrown out for an alternative politically. Does that make room for a growth in a tech industry that has never really been able to flourish over there, but has done bonkers good here in the U.S.? Are you starting to see that in London? Do you expect to be able to see that on the continent?
Well, there is sort of an underappreciation of technology businesses in the UK, but they're clearly not as dominant as they are in the US, and likewise on the continent. But of course, ASML is just almost sort of a linchpin in this sort of semiconductor industry, but it's clearly not such a dominant a stock within the market. It's just going to be too hard to displace the US as the home of innovation and technological innovation. But, there are opportunities in European equities to exploit this trade. I've mentioned one name already. But for the asset allocators, if you want to get a more meaningful piece of this trade, of course, you have to lean into the US.
In terms of growth there. We see it kind of slowing down here. You've already, or the ECB at least, has already started cutting. They didn't really give us a path forward, but what does the growth picture look like to you as the ECB contemplates further cuts?
Well, I think it looks pretty reasonable, pretty downbeat expectations for Europe by and large. But as I said, a combination of real income support, so wages continuing to running at quite a reasonable level, but inflation falling much faster on the continent than in the US, for example, is giving consumers room for manoeuvre. And we are starting to see or there's increasing evidence of the manufacturing sector doing reasonably well. So that's good for Europe, really heavily integrated in the manufacturing sector. You take an economy like Sweden, something of a lead indicator on sort of global trade and global manufacturing. Their PMIs, their leading indicators suggest manufacturing is picking up. So that's good news for Europe. You know, over the medium long term, we're well aware that the sort of structural challenges of such a fragmented market in Europe and the links to China and all the challenges there don't set Europe up for sort of sustained long-term higher levels of growth. But in the shorter term, perhaps the growth outlook looking a little better.
It is so fragmented. The EU, not a monolith, as we get, painful reminders of time and time again. You mentioned Sweden. We talk a little bit about the UK. Where do you think are the best regions to invest in Europe?
Well, I mean, I would say the UK, but that would circle back to our prior earlier in our conversation, where we think the US looks set up to be the best performing market over the medium term. And what you're getting there is sort of tech-heavy exposure. To build diversified portfolios, you need something of a hedge against that. And the valuation opportunity in the UK and the geopolitical hedges of the resource sort of dominant sectors that are in this market make that a nice barbell. Within Europe at the moment, over the short term, France looks like a decent opportunity, because of the sort of shorter term discounts. But of course, it's home to such great luxury brands as well, and such fantastic technology businesses. So there are opportunities everywhere, but on a high level, we think US, UK makes like a nice barbell.
Got it. Ben, thanks so much for joining us. Hope we can get you back soon. Ben Gutteridge there of Invesco, talking about the situation on the other side of the pond and what kind of opportunities the concerns open up. Coming up, Ryan Reynolds joins Mountain, or he has joined Mountain a while back as Chief Creative Officer. He gives a go at pitching the business in a new campaign. We'll go live to Cannes and speak with the Mountain CEO, Mark Douglas. Look at how streaming giants are spending ad dollars. This is Bloomberg. The top voices in advertising and media are gathered for the Cannes Lions Festival in southern France. One focus is how streaming giants are changing advertising. Joining us now is Mark Douglas. He's the CEO of Mountain. It's an ad technology company that builds software for brands. And Mark, great to have you on the program. You have a chief creative officer in Ryan Reynolds,
yes.
And he has recently made an attempt to kind of pitch the business, your new program, Mountain Match. Tell us what's that about and what's it achieving?
Yeah, so one of the things that Mountain is entirely focused on is bringing small and mid-sized businesses into the television advertising market. And so these are direct-to-consumer brands, usually e-commerce brands, or travel brands coming to television for the first time. They don't have huge budgets. So they have a hard time, they're not broadcasting out millions of dollars on the TV. So we have to really identify their right consumer and kind of literally match them. Like, this consumer, you would love this brand. And then we make that match via the TV ad. So we released something called Mountain Match, which uses 2 layers of AI, generative AI and machine learning, in order to literally match consumers with the right brands and then show them the TV ads for products they're potentially going to love.
And of course, when you linked up with Ryan, I mean, that was kind of what he was famous for. It's his sort of creative genius in creating ad campaigns matched with your sort of engineering technology at Mountain. helps you take on sort of the Goliaths. Amazon, I'm guessing, and Netflix are two of those Goliaths, right? How do you deal with those two?
Well, we're partners with every streaming network in America, all of them. And we're bringing 90% of our customers have never advertised on television before. So that's a huge stat. And so they love Mountain is bringing these new advertisers in the market. But again, these customers, they're used to using paid search and using these super targeted platforms to find the right consumers. So they need that kind of technology in order to get access to Mountain customers, to get access to this new cohort of customers. And so they're excited about it. I think they're battling each other. And meanwhile, Mountain is above the fray, just like bringing new companies into this market every single day.
So how strong is the sort of comeback of advertising on television? Because for so long, Mark, I could stream stuff without seeing any kind of traditional commercials. Now, when I'm watching things, for example, on Hulu, they do pop up every 30 minutes or so, and I will, sit through and watch.
Yeah, it's very back to the future for TV advertising, and there's no TiVo anymore, right? It's all 30 seconds, unskippable. But what's happened is the quality of the ads themselves have gotten better. And then like what I'm talking about, Mountain Match and other technologies are making it so that they're way, way more relevant. So those consumers that are now seeing the ads that maybe they weren't through a subscription, they're willing to trade that because they're much more relevant. They're almost part of the entertainment increasingly if they're good and they're very, very relevant. So I think it's, the industry is growing. I think there was a bit where it was stalled, but it's kind of growing, and it's because it's more relevant, more brands, like Mountain bringing more brands in the industry is just making a big difference.
So you're there in Cannes, and Elon Musk is going to be courting advertisers in Cannes, apparently in a speech or an interview, rather. Give me your take on what the Tesla CEO, the Twitter CEO, the SpaceX CEO is doing, because a lot of people wonder, does this guy have a plan? Is it headed somewhere, or is he just like throwing spaghetti at the wall all the time?
Yeah, so I think obviously Elon is one of the biggest innovators of our time. I think people would probably think Steve Jobs, and these days think Elon. And Elon's doing it in the physical world. He's launching rockets. He's building cars. With X, it's software. And I think a lot of folks are just not that used to seeing someone innovate in real time and do it so publicly and announce ideas and then, change his mind. And I think that kind of seeing how the sausage is made kind of freaks some people out. But it's part of the process. And so I think someone like me, I'm an engineer originally by trade. I mean, I think we see it as fantastic because that's the process. But the rest of the world sees it as schizophrenic, maybe is the right word. But it's all headed in the right direction. I'm a big fan of everything he's doing, including what he's doing at X. I think he will get there, and I've said that for quite a while now.
Mark, we have a viewer writing in with a question. He asked, do you think Silicon Valley is going to keep picking away at traditional media? How can anyone compete against Silicon Valley with an endless wallet to buy content?
Well, the thing is like these mediums like television, even billboards, what's referred to as out of home, have become digital, and Google and Meta play no role in them and won't be playing a role. So I think, the Google and Meta are now competing with an entire industry of media companies who are now armed with digital technology themselves. And I think it's, battle royale right now, and it's a fun time to be participating in it.
All right, Mark Douglas, thanks very much for joining us, CEO of Mountain from Cannes Lions. Now, for some of the sector price action that we're watching in the market this morning, let's get back over to Bloomberg's Abigail Doolittle. Abby?
Right now, we have the S&P 500 heading to another high, Matt, another record high, closing record high, an all-time high, and it's a broad-based gain sector-wise. Energy is the top sector, up 1.6%. We have a bit of a reprieve here for real estate, the only sector down on the year. Right now, up about 0.6%. To the downside, communication services, utilities, discretionary industrials, but a small gain that is well supported. Let's take a closer look at that energy sector because it has been steadily higher, and one piece of it is Occidental. Warren Buffett adding to his favorite energy bet, buying for 9 straight days in a row. The stock up 3 straight days in a row, and you can see today's spike there.
All right, Abby, thanks very much for that. Coming up, we're going to give you the market-moving events you need to watch. That's next in our trading diary. This is Bloomberg. Time now for the trading diary, what you need to be watching today and this week. Later today, we're going to get the tick flows, so pay attention to those. And then obviously a slew of Fed speak will continue this afternoon. Tomorrow, U.S. markets will be closed for Juneteenth. And then Thursday, we get the Bank of England rate decision. You can type BOE GO on your terminal for that. And we round out the week with existing home sales. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.